Choosing individual stocks and bonds can be very overwhelming. There are thousands of companies out there, so how do you know which ones to pick? How many should you buy? Do you even have the time to research everything? That is where mutual funds come in. They are one of the most popular investment vehicles in the world, with over $20 trillion invested in them in the US alone. But what are they exactly? So today I am breaking down mutual funds in the simplest way possible with real examples that will make you go, that's what those are. And by the end of this video, you will understand how they work, why people invest in them, and whether they might be right for you. So let's dive in. I want to use the pulling together analogy, right? So I want you to imagine three moms: Jasmine, Grace, and Danielle. They each want to invest, but they don't want to research stocks or pick companies. Jasmine has $200 to invest, Grace has about $50, and Danielle has $500. Individually, that does not even go far when it comes to investment, to be realistic, but together they can pool their money and hire a professional who says to them, I can take your combined $750 and buy a mix of stocks and bonds for you. I will handle choosing them, reviewing them, and adjusting them over time. So that group investment with a manager making the decision is exactly how mutual funds work. So millions of people put money into these funds, and the fund manager, they use the total pool to buy investments on everyone's behalf. So you get the exact same fund whether you invest $50, $5, or $5,000. So that's exactly how mutual funds work. A mutual fund pulls money from thousands of investors, millions in some cases, and they use it to buy diversified collection of stocks, bonds, or other assets. So a professional fund manager makes all the decisions, the buying and the selling decisions. So whatever profit or losses the fund makes, you as an individual, you get proportionality based on the share you have, right? How much you've invested in the fund. Just like the basket gives you, variety without you buying everything individually, a mutual fund gives you investment diversity without buying every stock individually. So let's go over how mutual funds actually work. Let's get into the mechanics with a real example. So imagine there's a mutual fund called the growth stock, right? That fund's goal is to invest in 50 different technology and healthcare companies that the manager believes will grow rapidly. You decided to invest $5,000, but you're not alone. There are like thousands of other investors who also put money in it. So some invest 1,000, some invest 50,000, some invest 5 million. Altogether, this fund collected 100 millions from all investors. Now that fund manager takes that 100 million and buys stocks in 50 different companies, 50 different growth companies. Let's say maybe they buy 5 million in Apple, 5 million of Microsoft stocks, 2 million of Johnson and Johnson stocks, 4 million of Nvidia stocks, and they do this for 50 different companies. They distribute the money and buy all those shares in those companies. So what do you own? You do not directly own shares of Apple or Microsoft. Instead, you own shares of that mutual fund, right, itself. With your $5,000 investment, you might own 100 shares of that growth stock fund. So those 100 shares, they represent slices of the entire 100 million portfolio. So you essentially own a tiny piece of all the 50 companies in that fund. So what happens next when you've already bought in this mutual fund? Let's say over the next 2 years, the stock in that fund performs very well. Apple goes up 20%, Microsoft goes up 15%, Nvidia 100%, and so on. The overall fund value increases from 100 million to 110 million. That's a 10% gain. So your investment, it goes from 5,000 to 5,500, and you just made $500, which is a 10%. But that's the beautiful part. You didn't have to research companies. You didn't have to decide how much should you invest in each one or monitor them constantly, right? The fund manager did all of that. You just bought into the fund and let them handle everything. Now, mutual funds also pay, what we call distributions. So if the company fund pays dividends, the fund collects all that dividends money and distributes it proportionally based on your shareholdings, right? So some funds sends you the payment as cash, and some might automatically, or you can choose to automatically reinvest them to buy more shares of the fund. Now I want to talk about the types of mutual funds, right? Not all mutual funds are the same. There are actually many different types, each with different goals and objective and strategies. So let's break down the main categories. The first one we have is called stock funds, which are equity funds. These primarily they invest in stocks, but they are subcategories. So we have growth funds. Those are companies that focus on growth rapidly. Most tech stocks do that. They are high risk, higher potential for reward. Then you have value fund. They focus on undervalued companies that are currently cheap, but they have solid fundamentals. They are like bargains, basically. Then you have index funds. These are the huge, big funds. They don't try to pick winners. They just copy a market index like the S&P 500. So if the S&P 500 contains 500 companies, an S&P index fund buys all 500 in the same proportions. So those are super popular because they're simple and they have very low fees. Then you have sector funds. These focus on specific industries like technology, healthcare, or energy. Then you have international funds. These invest in companies outside the United States. They give you that global exposure. Then you have bond funds. These invest primarily in bonds, government bonds, corporate bonds, or municipal bonds. They're generally low risk than stock funds, and they provide steady income through those interest payments. These are very great for conservative investors or retirees, right? You have hybrid funds. They invest in both stocks and bonds, and they're designed to balance growth with potential stability. They're perfect for those who want like a one-stop shop investment where you don't want to be deciding and moving money around. Then you have money market funds. These invest in very safe short-term debt instruments. They're super stable and liquid, almost like a savings account, but typically they pay slightly higher interest rates. They're very, very low risk, but they also have very low returns. Then you have the target date funds. These are like amazing for retirement planning. So when you pick a fund based on when you plan to retire, let's say you're planning to retire around 2055, you would invest in a target 2055 fund. So what are the pros of mutual funds? Why do people love mutual funds? What are the big advantages? Number one, you have instant diversification. So this is like very important. Let's remember diversification means not putting all your eggs in one basket, right? So if you tried to buy 50 different stocks on your own, one, you're going to need a lot of money, tens of thousands of dollars. But with a mutual fund, you can get that same diversification with just $1,000 or even less in some cases. Let's say you invested all your money in just one company and that company goes bankrupt. You would literally lose everything. But if you are in a mutual fund with 50 companies and one goes bankrupt, it only affects 2% of your investments, right? The other 49 companies, they cushion that blow up. Number two is professional management. So you're literally hiring an expert, which is a fund manager, that have teams of analysts, access to sophisticated research, and decades of experience. And so they're watching the markets, they're analyzing the markets. That's like their full-time job while you're at your own job. So they decide when to buy, when to sell, and how to rebalance the portfolio. Another advantage is accessibility. So most mutual funds have low minimum investments, often around 1,000 to 3,000, sometimes even less. Some workplace retirement plan, they let you invest with no minimums at all. So compare that to buying, 50 individual stocks, which will cost you a lot of money, more than probably $100,000 or more. Another good thing is liquidity. You can sell mutual funds any business day and get your money back at the current share price. It's not like buying, a car or buying real estate where you might take months to sell it. Another advantage is automatic reinvestment. So many funds offer dividend reinvestment plans, which we call DRIPs. Instead of receiving dividends payment as cash, the fund automatically can use that money to buy more shares, and which will compound your return over time without you having to do anything, right? Another advantage is the variety of choices. There are like thousands, over 8,000 mutual funds in the United States alone. So whether you want aggressive growth or steady income or international exposure or anything in between, there's probably a fund that you can find that does that. So let me give you a real example. So one of my friends, Sarah, she's a teacher with very busy schedule. She doesn't have time to research stocks or does not even have the knowledge to do so. So she invests $500 per month into a target date fund in a 403b retirement account. It's automatically diversified across like thousands of stocks and bonds, and it adjusts over time. And she literally does nothing except contribute to it. In 10 years, she's built up over $80,000, and that's the power of mutual funds for everyday people. Actually, $80,000 is like on the lower end. So let's talk about the cons, right? Mutual funds are not perfect. They have some downside and you need to know about them. Oh, the first one is fees. Oh, can I repeat that? The first is the fees, which we call the expense ratio. Mutual funds charge an annual fee called an expense ratio to cover like the funds manager salary, the research, the administrative costs, and so on. This is a percentage of your investment. So, for example, an actively managed stock fund might charge you 1% per year. An index fund might charge only 0.05% per year. That might not really sound like too much right now, but when it compounds over time, it's a lot. Let's say you invested $10,000 for 30 years with an average 8% annual return with a 1% fee. You end up with about $7,600. With a 0.05 fee, you end up with about $99,000. That's 0.95% difference in fees that cost you $23,000. Over decades, those fees matter enormously. The rule is to stick with low expense ratio index funds. Anything over 1% is expensive. Number two is the lack of control. So you're not picking the stock, the fund manager is. So if they make any bad decision, you're along for the ride. You can say, hey, don't buy that company, or I don't like this company. Or tell them to sell the company right away. Number three is tax inefficiency. So when the fund manager sells stocks for a profit, the fund realizes what we call capital gains. Those gains get passed on to all the shareholders as taxable events or taxable distribution, even if you didn't sell any of your shares, right? So this can kind of create an unexpected tax bill that you might not be aware of. So index funds are more tax efficient because they trade less frequently. Actively managed funds, they trade a lot, so generating those taxable events I mentioned. Another con is active management often underperforms. There's a saying that most fund manager on Wall Street, they underperform the indexes. So it's almost better to stick with an index fund instead of an actively managed fund, because studies have shown that over 80% of active fund manager fail to outperform a simple index like the S&P 500 over a 10-year period, even before accounting for their higher fees. So you're often paying 1% for a manager to underperform the S&P. I wouldn't do that. So from an index, you can get 0.05% fees. So another con is the minimum investment and restrictions. So some funds require 3,000 or more to start, which is a barrier to entry, especially for new beginner investors or those that are new to investing or have limited limited funds. Another con is that it doesn't trade anytime during the market open. It trades at the end of the market close, right? All right, so let's say you're interested in investing in mutual funds. How do you choose one? That's very important. For me, here is what I look for. The first thing is to match your goals, right? Currently, my goal is aggressive growth, right? So I would consider a growth stock fund. Let's say I needed more income, I would look at bond funds. Let's say I want to balance my portfolio, I would try a balanced fund. If I was planning for retirement, I will look for a target date fund, right? Another thing is that I would check for the expense ratio. So the lower the better. So I aim for anything under 0.50 for actively managed funds and anything under 0.20 for index funds. I also look at performance. I want to see how that stock has performed over the past 5 years, 10 years, or 15 years. The thing I look for is to understand the holdings. I want to look at what's actually in the fund, right? A diversified growth fund might be heavily concentrated in, let's say, tech stocks. I want to make sure it aligns with what I want, right? And then another point is I read the prospectus, right? That's an official document describing the fund strategy, what the fees are, what are the risks, and what is in the fund. It is boring, but at least skim through it, right? At least at a minimum. And then I want to consider what is the manager's tenure. Is this someone that is new, or is this someone that's been on the fund and has a record? Is it the same manager running it? Is it a new manager or a different? Because a new manager might have a different approach from a previous manager, right? What are some popular examples of index funds, mutual funds to consider? An example is Vanguard 500 Index Fund, VFIAX. It tracks the S&P 500, has an expense ratio of 0.04%. You have the Fidelity Contra Fund, FCNTX, which is actively managed large cap growth fund. You have the Vanguard Target Retirement 2060 VTTSX. If you're retiring around 2060, I mean, I will tell you honestly, there's thousands of different types, right? What you want to do is just pick one that is broad enough, diversified enough to give you exposure to the type of market you're looking for. So let's wrap it up. A mutual fund is an investment vehicle that pulls money from many investors to buy a diversified portfolio of either stocks, bonds, or even sometimes other assets, right? It is actively managed by a professional fund manager. You own shares of the fund, which represent a proportional stake in everything that the fund owns, right? You do not own shares of the actual stocks. What are the pros? You have instant diversification, you have professional management, you have accessibility and simplicity. What are the cons? The fees and the fees and the fees. The fees can eat into your earnings, so you lack control. And also, most active managers, they underperform simple index funds. Mutual funds are a very fantastic tool, especially for beginners or busy people who want to invest without becoming full-time stock pickers. And they are the backbone of most of the 401ks and retirement accounts, for good reason. They're tried and proven. So my advice, if you're just starting out, is to consider a low stock index fund or a target date fund. They're simple, they're effective, and they have low fees. As you learn more, you can then broaden and branch out if you like. So if you found this helpful, please give it a thumbs up. In the comments, put what type of mutual funds you're interested in, and let me know what you're looking to buy or what you're currently invested in. And please subscribe for more if you enjoy the content, and if you want to continue to follow for more basic investment videos. All right, thank you very much. I'll see you guys in the next session.